Hey everyone, Brian Bogner, Greg Towner here with Parallel Portfolios. It's time to talk about our 5 charts in 5 minutes that we do, where we bring you information that we believe is important. There's a lot of noise out there, right, Greg?
Yeah.
We had tariffs, right? Oh my gosh, tariffs are happening. The market went down, a lot of fear, a lot of volatility. Then we found out, well, tariffs aren't going to be as bad as we thought they were going to be, but they're still there, and markets rallying. But some people say yes, but there's still strong chance of recession. Other people are saying, well, market's going to go to the moon from here. There's a lot of noise. There's a lot of people on both sides. So in the next 5 minutes, we're going to show you some things that we believe are important when it comes to the markets. Take it away, Greg. Let's go.
Yeah, absolutely. More noise than even normal here. So let's
Yeah.
talk it through. We usually like to start with this 3-year chart of the S&P 500. And we're going to focus mostly on the right side because obviously the last couple of months there's been a lot going on. So I kind of want to set the stage for the next chart before we get to it. From the highs there in February to the lows into the kind of early to mid-April period, the market as the S&P declined right around 20% or so. Well, then what happened was it actually recovered pretty quickly, more than 50% of that decline. That was right up around the 200-day moving average. We've actually gone higher than that now. We're back above the 200-day, which is that in of itself is usually a positive. So why I'm pointing this out, 20% decline and then a 50% or more recovery, that's really important as we go to the next slide because we looked at this study going back to when the S&P started in the 1950s. Anytime that has happened, so when the market has at least recovers half of its decline, going out 12 months, normally it's had really, really strong returns. All but once was a positive, and a lot of those were much stronger than normal. So in other words, it's saying when the market recovers half of its decline, it's usually not going to go back and make a new low. Now, the big exception there is 2008 financial crisis, right? So no study is perfect. There's always going to be some outliers. Now it's a big one. But normally, when the market is strong enough to recover half of its recent decline, it's good looking forward. Another factor we wanted to point out here, I know there's a lot going on the screen. This going to be a little more technical in nature, but we think it's important. At the bottom, it's showing the percentage of stocks. This is a very long-term chart to the 1960s. Percentage of stocks trading at a new 20-day high. Recently, we hit 50%, 57% of stocks, right at that blue line, that reached that. And historically, that data in the top left shows us that when there's that strength of momentum in the market, 12 months forward, you have stronger than normal returns and a very high percentage of times stocks are positive. So again, nothing is perfect, but a lot of these measures are happening within the market when everybody's just still focused on the headlines of, tariffs, debt, that sort of thing. Underneath the surface, some positive momentum is actually happening.
So, Greg, we're seeing some positives here on the market underlying here. Talk to us a little bit about the US government just got downgraded, right? Talk to us a little bit about that and how that relates to what's going on here.
Yeah, that was the big news over the weekend that Moody's downgraded the credit rating of the US government debt. So this is actually a chart going back to when Standard and Poor's did the same thing 14 years ago. So there's a big gap between the two doing that. But at that time, what we looked at, the black line is the S&P 500. The red line is the 10-year yield. And that vertical dotted red line is when they did the downgrade. And what we saw after that, the black line, the S&P actually did better than normal. If you started off a little bit negative, but then 3 to 12 months later, it actually did much better than it normally does during that period. Yields shifted down for a little while initially. So this is back when, not as many people were focused on the government debt, and yet still the market did well looking out. Now it's kind of an old story. Stock futures, started open or, opened the market down on Monday when people were worried about that, and then it quickly moved higher. So yes, there's debt problems with the government, but I think people have long factored most of that in. Here's another example of that. So this is the chart that looks at triple B rated bonds. Okay, so investment grade, but not the highest level, compared to Treasury bond yields. So as this line is going up, investors are demanding a higher yield due to concerns about risk compared to, say, safe Treasury bonds. We saw it spike here recently with the whole onset of the tariffs and that. It quickly let off, and there's been no move up with the downgrade of the Moody's downgrade of government debt. So really right now, credit markets are looking pretty healthy.
And let's be honest, we can talk stock market, which obviously most of us are, invested in here, and that's important. But the real, when you think about the big institutional investors, what I like to call the smart investors, what is the bond market doing? What are the credit markets doing? Because that's where the smart investors are. And when spreads are narrowing, right? Then they're willing to take on risk, right? They're not willing to recede. And that's what we're seeing right now. So, in the midst of all these negative headlines, the smart investors are willing to take risks. So, yes, there's a lot of negative headlines right now, and that's what we're focused on. You've heard us say this again and again and again and again. But, we're not here to just talk about negatives and we're not here to just talk about what's being in the news. We're trying to look under it all, like open the hood, look down in, how's this engine really running? Where are the risks? Where are the issues there? And so right now the market's looking past a lot of these risks. And what we're seeing based on historical data is that there's some potential for upside and more positive. So, as always, you know how to reach us. Give us a call, shoot us an email. Thank you so much for watching today, and have a great rest of your week.